What if I told you that one single infrastructure stock just quietly erupted 90% in exactly 2 weeks, completely off the radar of most retail investors, and then received what might be the most powerful endorsement in the entire semiconductor industry? And what if the very event designed to send it even higher is actually the moment it could all fall apart? Welcome back to Smart Stock Sam, the channel where we cut through the noise and bring you institutional-level analysis without the Wall Street jargon. If you are new here, smash that subscribe button right now, because today we are doing a deep dive into Marvell Technology, ticker symbol MRVL. We are talking about a stock that just joined the S&P 500, secured a $1 trillion partnership endorsement, and is sitting on the edge of either the most explosive breakout of the summer or one of the nastiest bull traps this market has seen in years. We are covering the anatomy of this extraordinary move, the 4 growth pillars driving it, the dangerous valuation math nobody wants to discuss, and a precise, data-backed trade blueprint for the volatile week of June 22nd. Stay with me all the way through, because the options strategy section alone could save your portfolio from a very costly mistake. Let's get into it. To understand where this stock is going, you absolutely have to appreciate the sheer velocity of where it just came from. Over the last 12 months, Marvell has delivered a staggering 361% price gain. But even that mind-bending number does not prepare you for what just happened in the last 2 weeks. The stock launched almost vertically from the mid-$160 range straight to a 52-week high of $329.88. That is a 90% gain in roughly 14 trading sessions. Let that sink in for just a moment. Then came a sharp, brief profit-taking pullback that dragged the price into the $252 to $280 zone before aggressive buyers stepped back in and pushed it right back to our current pivot level of $310.58, where it sits as we record this. Now, here is the key question that separates smart money from Reddit hype. Is this raw retail momentum, or is something far more structural driving this? The answer, when you look at the institutional data, points overwhelmingly to the latter. Over 1,500 institutions are currently holding approximately 761 million shares, representing 87.09% of the entire float. This is not a meme stock. This is a deliberate, coordinated, institutional accumulation play, and there are 4 very specific reasons why the big money is loading up. The first pillar is the Nvidia endorsement, and this one is genuinely extraordinary. Jensen Huang, the most powerful voice in the entire semiconductor ecosystem right now, publicly called Marvell a future trillion-dollar company. And Nvidia did not stop there. They backed it up with a $2 billion investment to deeply integrate Marvell into the NVLink Fusion ecosystem. When the most important company in artificial intelligence decides to anchor its interconnect architecture around your product, that is not a marketing win. That is a structural, multi-year revenue guarantee baked right into the fabric of the next generation of AI infrastructure. The second pillar is the S&P 500 inclusion. On June 22nd, Marvell officially replaces Pool Corporation inside the index. This single event forces a massive, completely inescapable wave of mechanical buying from every single passive index fund and ETF that tracks the S&P 500. There is no discretion involved. Fund managers do not get to choose whether they buy. They have to. And that forced liquidity injection happening on a single day creates an extraordinary price dynamic that we are going to unpack in detail. The third pillar is Amazon AWS. Reports are emerging that Amazon is now expanding the availability of its Trainium artificial intelligence chips by offering them to third-party customers, not just internally. That directly and substantially widens the total addressable market for Marvell's AI networking and connectivity solutions. And the fourth pillar is pure, undeniable execution. Marvell and Tower Semiconductor just crossed a historic milestone, shipping over 5 million coherent photonic integrated circuits. That is not a roadmap promise. That is 5 million units of real product in the hands of real data center operators, cementing Marvell's dominance in the AI data center interconnectivity space. 4 pillars, all pointing in the same direction. Now let's look at whether the financial results actually back up the hype. When you open Marvell's Q1 fiscal 2027 earnings report, the headline number is record revenue of $2,418 million, which is a 28% increase year over year. Impressive. But the number that should stop you in your tracks is this one, $1,830 million, or exactly 76% of total company revenue comes from a single segment, the data center. Management is so confident in this trajectory that they have already raised their total fiscal 2028 revenue target to $16,500 million. Now, I want you to hold on to that number, because in a few minutes, I am going to show you why that target is both the most exciting thing and the most dangerous thing about owning this stock right now. But first, let's talk about what the people inside the company are actually doing with their own money, because that contrast is something you absolutely have to see. On one hand, you have institutional titans pouring money in with both fists. On the other, insiders are walking out the door with their pockets full. The outgoing chief financial officer just filed to sell 48% of his holdings, cashing out over $60 million. The chief executive officer sold 7,500 shares. The chief operating officer sold 10,000 shares. Before you panic, let me give you the context. Most clickbait channels deliberately leave out. When executives are sitting on enormous, unrealized gains at all-time highs, taking chips off the table is standard, legally pre-planned behavior. Not a secret signal that the company is imploding. What matters far more is the aggressive M&A happening simultaneously. The acquisitions of Celestial AI and XCon, and the recruitment of former Adobe Chief Financial Officer Dan Durn. These are not the moves of a leadership team losing faith. The institutional ownership of 87% of the float dwarfs the insider selling entirely. Keep that in proper perspective. Now here is the part that makes the valuation story genuinely nerve-wracking. The broad Wall Street consensus price target for Marvell sits somewhere between $233 and $238. The stock is currently trading around $310. That gap alone tells you how dramatically the market has repriced this company in recent weeks. Analysts are scrambling to catch up, with B. Riley slapping a $345 target on it, GF Securities going to $350, and KeyBank maintaining an overweight rating all the way up to $385, citing durable, long-term growth in optical networking. But here is the cold, hard mathematical reality that every single buyer needs to accept before pressing the button. Marvell is currently trading at a trailing price-to-earnings ratio of over 106 times. The forward price-to-earnings ratio is 76 times. 76 times forward earnings. Let me be very direct with you about what that number means. At 76 times forward earnings, this stock is not pricing in good execution. It is not pricing in great execution. It is pricing in absolutely perfect, flawless, zero-miss execution across every single hyperscaler contract they have won or will win over the next 12 to 24 months. If one major customer delays a deployment, if one hyperscaler decides to accelerate its in-house custom chip program, or if data center capital expenditure growth merely slows down rather than collapses, the premium on this stock will compress fast and it will hurt. That is not a prediction. That is just arithmetic. Let us look at the technical picture now, because the chart is setting up a fascinating battleground for next week. Marvell is in a strong bullish trend, trading comfortably above its key long-term averages. The 14-day Relative Strength Index sits in a healthy, neutral to bullish zone between 55 and 61, meaning the stock is technically not overbought despite the massive run. Immediate support sits at the 20-day simple moving average of $301.86, and longer-term structural support is way down at the 200-day moving average of $233.39. But here is the technical red flag you need to mark on your chart today. There is a massive air gap between the current price of $310 and the 50-day moving average at $287.59. That gap creates serious vulnerability. If momentum stalls for even a few sessions, mean reversion toward that 50-day average becomes the path of least resistance. And before you start whispering about a short squeeze driving the next leg up, let me stop that theory cold with the actual data. The short interest as a percentage of the float is a microscopic 4.04%. Days to cover is a fraction of a single day, specifically 0.82 days. The short borrow fee rate is effectively zero, at just 0.41%. There is no short squeeze here, not nearly enough short interest to create one. What this rally is, from the data, is 100% organic, legitimate, institutional accumulation ahead of a major structural market event. Short squeeze is not your catalyst. Do not build a trade thesis around it. So, what is the actual catalyst shaping price action next week? It is the options market, and the setup there is one of the most compelling and dangerous configurations I have analyzed in a long time. Implied volatility on Marvell is sitting at 108.15%, ranking at the 85th percentile of its own historical range. The put-to-call ratio is 1.31 across over 2,100,000 open contracts. Right now, there is a massive cluster of call volume at the $330 strike, acting as a gravitational magnet on the upside, but also as a ceiling because market makers are forced to hedge aggressively against it. On the downside, dense put-open interest at exactly the $300 strike provides powerful structural support. The result is that Marvell is effectively trapped in a high-stakes gamma corridor between $300 and $330 heading into the inclusion event, and the catalyst that will determine which wall finally breaks is happening this Monday. The S&P 500 inclusion on June 22nd has three distinct phases. We have already lived through Phase 1, active speculation, front-running, and pre-announcement accumulation as institutional players positioned ahead of the official announcement. On Monday, June 22nd, we enter Phase 2, the liquidity nexus. This is when Marvell officially replaces Pool Corporation inside the index, and trillions of dollars in passive capital are forced to mechanically rebalance. Expect enormous block trades, exceptional volume spikes, and extreme intraday price swings. But here is the phase that most retail investors are not prepared for. Phase 3 is the volatility risk. Historically, S&P inclusion stocks run into the announcement, spike on the actual event, and then suffer a sharp, sometimes brutal, sell-the-news reversal once the forced buying is complete, and the stock transitions from active speculative accumulation into passive index holding. You have been warned. This brings us to the fundamental risks you need to keep in plain sight before you take any position. The first is the valuation paradox. That 76 times forward earnings multiple is not built on legacy contracts. It is built on the expectation that every single new hyperscaler design win flows smoothly into production revenue. But there is a 12 to 24-month lag between winning a design contract and actually recognizing revenue from production shipments. That means the stock price could very easily outpace the actual cash flow for several quarters while investors wait for the pipeline to convert. The second risk is customer concentration. Approximately 80% of Marvell's total revenue comes from their top handful of customers. If even one major hyperscaler decides to accelerate its internal custom chip program and reduce external orders, the revenue impact to Marvell is immediate and severe. These are not hypothetical risks. They are structural realities you have to price into your decision. Now let me give you the exact execution blueprint for the week of June 22nd through the 26th. The current price is $310.58. The bias is volatile and mean reversion aware. Your resistance ceiling and breakout target zone sits between $326.08 and $330. That range aligns precisely with the 52-week high and the massive $330 call wall. If you see a clean, sustained high-volume break above $326.08 with strong breadth confirmation, that triggers a breakout long entry and completely invalidates the mean reversion thesis. However, if the sell the news event triggers post-inclusion, your first pullback buy zone and primary support sits between $300 and $301.86. This is an extraordinarily well-defended zone, backed by the 20-day moving average and over 1,600 open interest put contracts acting as a floor. If that floor collapses and selling accelerates beyond $300, your secondary buy zone is between $287.59 and $290, where the 50-day moving average provides structural support. And now, the most critical piece of this entire breakdown: how you express this trade matters just as much as identifying the levels. Because implied volatility is sitting at 108%, buying naked directional calls or puts right now is one of the most dangerous things you can do with your money this week. Here is exactly why. When a massive event like this S&P inclusion concludes, implied volatility almost always collapses sharply. That collapse, called implied volatility crush, directly destroys the value of any option premium you purchased, regardless of whether the stock moved in your direction. You could be completely right about the direction and still lose money, or even lose everything you put in. The smarter play is to become a net seller of this expensive premium rather than a buyer of it. Consider credit spreads, such as selling the $285 puts or constructing an iron condor bounded between $285 on the downside and $335 on the upside. These structures let implied volatility work for you rather than against you. Before we wrap up, there is something important I have to say. Everything discussed in this video is strictly for educational and informational purposes only. I am not a licensed financial advisor, and nothing here constitutes personalized financial advice. Every investment involves risk, including the potential loss of your entire principal. Always do your own thorough research, consult a qualified financial professional, and never invest more than you can afford to lose. Markets are unpredictable. Past performance, even a 361% gain, is never a guarantee of future results. So let us bring it all together. Marvell Technology is without question the premier connectivity and infrastructure play for the artificial intelligence data center revolution. The Nvidia partnership, the S&P 500 inclusion, the AWS market expansion, and the 5 million Photonic circuit milestone represent four legitimate structural growth pillars that justify serious institutional interest. But the 76 times forward earnings valuation, the 80% customer concentration, and the imminent sell-the-news risk surrounding the June 22nd inclusion make this one of the most technically complex high-stakes setups in the entire market right now. Short-term traders must respect the gamma corridor between $300 and $330. Long-term investors must practice ruthless risk management and accept that the stock may very well outpace its actual cash flows for the next several quarters. Now, I want to hear from you directly. Right now, the market is obsessed with Marvell and the S&P inclusion hype. But here is the question I keep turning over. Is there any realistic scenario where Marvell's hyperscaler customers all accelerate their internal chip programs simultaneously? And what would that actually do to a stock priced at 76 times forward earnings? Drop your honest thinking in the comments below. I read every single one. If this breakdown gave you a genuine edge heading into next week, hit that like button right now. It takes 2 seconds and helps this channel reach more investors who deserve this kind of analysis. Subscribe if you are not already part of the Smart Stock Sam family, because we do this every week across the most important setups in the market. And if this video delivered real value today, consider hitting the super thanks button below. Every contribution directly fuels the research, the tools, and the time that goes into breakdowns like this one. Your support means the world. And finally, if you are serious about leveling up your investing and trading beyond just watching videos, I have launched an exclusive Smart Stock Sam membership community right here on YouTube. Members get early access to trade setups, deeper analysis, live Q&A sessions, and a community of like-minded investors all focused on making smarter, data-backed decisions. The link to join is right below this video. Come in, level up, and let's build real wealth together. I will see you in the next one.